Microsoft Corporation, stock ticker MSFT, has spent most of the back half of 2025 above $500 a share, but we can see in the last month they've sold off, down by about 4%, now trading at $493.79 per share. And you could argue this is due to a few different reasons, but really what's going on is people are starting to become more and more concerned about the spending on AI. Both Amazon and Microsoft recently got downgraded by the firm Redburn. The financial firm does not believe that the current titanic investments in artificial intelligence related infrastructure will produce returns justifying the expense. That's a big claim, and it's led to a little bit of a sell-off, and we need to analyze whether or not it's true. Now, for reference, Microsoft is a stock I've held in my portfolio for a while now. It's one of the largest individual positions, and it's a stock I've done very well on. I'm currently up about 88%. I was up over 100% before this recent sell-off. And for reference, historically speaking, Microsoft has been an amazing dividend growth stock. We can see right now the yield obviously is low at about 0.67%, but the dividend growth has been consistent and it's been relatively high. And all this dividend growth, of course, has been backed by growing free cash flow. And so because free cash flow is growing faster than the dividend, the free cash flow payout ratio has actually been declining over time, which is something we love to see. Now, while there's certainly scares about AI spending, there's still a lot of analysts quite bullish on Microsoft in particular. In fact, the average analyst rating is actually giving them about 27.55% upside from its current prices over the next 12 months, giving them a price target of $629.81. Now, that's kind of a short to midterm price target. We want to know about the long term. So let's talk about it for a moment. Now, if you were paying close attention to the free cash flow for Microsoft over the last few years, you probably noticed something that's quite interesting. 2024 free cash flow was actually higher than it was in 2025. Remember, Microsoft has already reported full year 2025 free cash flow, and they saw a pullback of about $2.5 billion. Why was that the case? Why is free cash flow declining? Doesn't Microsoft seem like a bit of an expensive stock trading at a PE multiple of 31.55 if their free cash flows are declining? Well, we have to understand why free cash flow declined, and this is something that they addressed in their recent earnings report. To start, if we go over to the fifth slide, they talk about cash flow. One of the things that they make note of is the sequential increase in capital expenditures includes a higher mix of finance leases, which had a lower impact on free cash flow. We have to remember capital expenditures lowers free cash flow. And this is where things start to get interesting. I ran across this chart the other day and I tweeted it out. What it does is it's showing us the cash flows in billions from some of the big AI stocks like Amazon, Google, Meta, Microsoft, and Oracle. Historically speaking, for the most part, these are relatively capital-light businesses. We can see in 2015 their cash flows were $91 billion and capital expenditures $25 billion, meaning capital expenditures as a percentage of cash flows was only 27%. And for the next few years, it's stayed in that relatively low range. But look at what's happened in just the last few years. In 2023, it got up to 63%, 2024, 50%. 2025 is estimated to finish at about 68%, and 2026, potentially 80%. These businesses are shifting from a capital-light structure to go all in on the AI race. And as a result, capital expenditures are going to increase significantly. And as a result of that, we're going to see free cash flow stagnate and maybe even decline in the short term. Now, this is what's scaring a lot of financial firms. These big tech companies' aggressive push into artificial intelligence is beginning to weaken traditional financial strengths. And that slight dip in free cash flow is an example of this. In fact, if we jump over and look at their balance sheet breakdown for Microsoft, we can see they're still in an incredibly healthy position overall. But in the short term, this balance sheet might start to slowly weaken over the next few years. Not to the point where it becomes unhealthy, but they probably won't be quite as cash heavy. These are the companies that entered the AI boom with minimal debt and hefty cash reserves supported by strong earnings unrelated to AI. I mean, just look at the earnings growth from Microsoft over the last few years. We can see EPS for Microsoft in 2015 was $1.49, and at the end of 2025, all the way up to $13.70. So we're just talking about explosive earnings growth, and it's backed by explosive top-line growth. Return on invested capital. How profitable are the projects the company's investing its capital into? It's been very good over the last few years, above 20% now for 5 consecutive years. If we jump over to the profitability sheet and look at Microsoft, and what we can see is not only are top lines growing at a very healthy rate, but overall profitability ratios have been expanding. Last year's gross profit ratio is about 68.82, which is above the 10-year average, which was already very good for Microsoft. So yes, these companies already have strong earnings unrelated to AI. But just like all these other big tech stocks, Microsoft is betting big on the AI race. And here's a good example of this. If we jump over to the quarterly data tab, let's look at Microsoft. But first, I want to say thank you to Dividend Wealth for sponsoring this video. And what you're seeing here is an example portfolio within Dividend Wealth. Immediately, we can see things like portfolio value, profit and loss, our forward-looking 12-month income, what our forward-looking yield is, as well as our yield on cost. I love that they show the yield on cost. I think that's such an important metric to track. But on top of this, I can also let Dividend Wealth know exactly what my goal is. For example, if my annual income goal is about $15,000, I can plug that in here and it tells me based on my contributions, based on dividend growth, how far away I am from achieving that goal, and we can see this on the dashboard as well. And one of the things they track that I think is so important is not just your allocation by market value, but your allocation by income. I can see my holdings on the holdings tab, I can see my diversification, and of course, I can see exactly what my income looks like, as well as a dividend calendar. When are my dividends coming in? And over just the next few weeks, Dividend Wealth is offering 50% off a lifetime subscription. Just use code DIVIDENDology25 and you can see you'll automatically get 50% off. Again, thanks to Dividend Wealth for sponsoring this video. Be sure to check them out at the link in the description. What we can see is, historically speaking, back in early 2014, CapEx to revenue for Microsoft was only sitting a little bit above 5%. Very little capital expenditures compared to revenue. This gradually increased as we got to around 2020, but then in the last couple of years, this has surged. CapEx to revenue in Q1 of 2026 was at 25%. That's a 5x from where they were just a few years ago, and keep in mind during that time, they also grew revenue by a large amount. Revenue in 2015 was $93 billion, 2025, $281 billion. So we're talking about a massive surge in capital expenditures to be a player in the AI race. So the question we have to ask ourselves is, how is Microsoft positioned to actually benefit from AI? Now, we could make a 30-minute to maybe even an hour-long video on that question, but there's a couple of things we have to note. When we look at some of the key business segments for Microsoft, it's not hard to imagine how easy it is to integrate AI into these different business segments. But let's for a moment talk about their relationship with OpenAI. Now, I've seen a lot of confusion on this subject, but if we look at a few of the key highlights, Microsoft has rights to OpenAI IP for the use within their products like Copilot. The OpenAI API is exclusive to Azure, runs on Azure, and is also available through the Azure OpenAI service. This agreement means customers benefit from having access to leading models on Microsoft platforms and direct from OpenAI. But then we can see Microsoft and OpenAI have revenue sharing agreements. Now, what does that mean? Well, essentially it means Microsoft does not directly own OpenAI, and that's really important to make note of. Instead, they have revenue sharing agreements. OpenAI reportedly shares around 20% of its revenue with Microsoft as part of a previous deal where the software giant invested over $13 billion in the AI startup. But keep in mind, Microsoft also shares revenue with OpenAI, kicking back about 20% of the revenues from Bing and Azure OpenAI services. Now, based on that revenue sharing statistic for Microsoft, we can estimate that OpenAI's revenue was around $2.5 billion in 2024, and through the first 3 quarters of 2025, about $4.33 billion. So essentially, we're going to see over 100% revenue growth from OpenAI, which again is very beneficial to Microsoft, who has the revenue sharing agreement. Now, make no doubt about it, analysts are expecting these heavy AI investments to pay off pretty handsomely. In fact, if we go ahead and jump over to the sensitivity analysis over on ticker data and look at Microsoft, we can now see that the average analyst estimate is giving them a projected EPS CAGR of 18.79% through 2029. Nearly 19% compounded annual growth rate of earnings per share through 2029. We're talking about rapid earnings growth. So the question is, at its current price, is Microsoft still attractive? And I think that's a loaded question. There's a lot to break down there. But here's what we do know. To start off, if we jump over to our stock analysis sheet and look at Microsoft, look at the historical multiple valuation for this company. If we zoom in quite a bit, here's what we can see. The average PE ratio for this stock over the last decade is sitting at 31.1. The trailing 12 months PE ratio was sitting at 34.98, which is about 12.5% higher than the average PE ratio over the last decade. Does that mean it's overvalued? Well, it depends. If Microsoft is projected to grow earnings at a faster rate moving forward, then a higher PE multiple is certainly justified. And from what we're seeing, that could potentially be the case. But at this point, all it is a projection. It's still speculation. Is the AI spending going to pay off? Because let's just say that the average analyst estimate is right at 18.79%. Let's project out what our returns would look like. Let's assume even the PE ratio pulls back a little bit, so there will be some multiple contraction closer to the 10-year average. What we can still see is by the year 2030, we're still looking at attractive returns. We'd have a total return of over 105%, not including dividends, and a compounded return of 12.77%. That's beating average market returns historically speaking, and that's even with multiple contraction. If they kept the exact same PE multiple, you can see those returns would go even higher to a total return of close to 125% and a compounded return of 14.46%. So all of a sudden, you can still see why a lot of analysts in particular are still excited about some of these tech stocks like Microsoft. But here's the big what if. What if Microsoft uses all this capital in the AI race and earnings don't shape up to be as high as they hope? Maybe they're only about 14%. Well, first off, what we have to understand is there would certainly be a lot of multiple contraction. Investors are paying a high multiple right now with the expectations of earnings growing at a high rate in the future. So if that's not the case, investors are going to be willing to pay a lower PE multiple. So if it pulled back to 28, which is still relatively high when you compare it to the broader market, but again, all of a sudden, you can see future returns don't look nearly as attractive, and they actually come in below what historic average market returns have been. So what do we make of Microsoft stock? The short answer is that if their CapEx spending pays off the way that it's expected to, according to the average analyst estimate when it comes to EPS in the future, then Microsoft is actually still pretty attractive at its current prices. It's well positioned to be a major beneficiary of AI, but at the same time, the amount of capital expenditures these big tech companies are having is what's scaring off a lot of investors and causing the murmurings of a bubble. For me personally, because I consider myself to have a longer time horizon, I absolutely do want exposure to some of the greatest companies in the world that are players in the AI race, and I think Microsoft is one of the best ways to do that. This has been the largest individual holding in my portfolio for a while now, and I don't plan on changing that anytime soon. But go ahead and let me know what you think of this stock in the comments down below if you plan on buying or selling, and like always, please don't forget to like and subscribe to the channel.